everyone, my name is Simon Misiewicz.
And my name is Louise Misiewicz.
And we are from Optimize Accountants. And tonight we're going to be talking and taking your questions about UK self-assessment tax returns.
Hooray!
So before we kind of kick off, I think there's a question on Google that I think is worth exploring and to kind of go through these key dates. So let's start with a question. What are the key dates for self-assessment tax? And in particular, we're talking about filing and payment of tax.
Okay.
Over to you.
Okay. Strap in, team, because there's a lot of dates here. So if you are looking at filing deadlines, if you want to file a paper tax return for your personal tax year and you want to post it to HMRC, you can still do that, but you must do it by the 31st of October following the end of the tax year. So our tax year ends on midnight, the 5th of April every year. So the 2021 tax year, as it's known, lovingly, finished on the 5th of April this year. You needed to file by paper no later than the 31st of October this year.
Which is gone.
So if you're now filing by paper, you can still file by paper, but you're likely to either get one of two things happen. You're either going to get it returned to you from HMRC or they're going to fine you for having filed late. And the minimum filing penalty for filing late is £100. If you're going to file electronically, so in other words, either load it directly into HMRC systems, and for certain types of tax returns, you can do so, or you're going to use some special proprietary software, then your filing deadline is the 31st of Jan after the end of the tax year. So for the tax year that's just ended on the 5th of April, 2021, you must file electronically no later than the 31st of January, 2022. However, if you want to secure the ability to pay your tax through future PAYE updates, so in other words, not pay a lump sum of tax if you've got some tax to pay over and above any you had taken from, say, salary, then you really need to have filed by the 31st of December 2021. Otherwise, HMRC won't take it out of your PAYE coding. So those are probably the first three key deadlines. Have I sent you over the edge yet?
So have we covered off? Sorry, I was just messing around with a bit of tech.
You were just messing.
I was messing around with tech, it's not working.
I should be telling him off later.
So the question is, have we covered off payments on account?
Oh, no.
The second payment account especially. So you've got the
No,
first
no,
payments account.
We
Do tell us what that is.
We haven't even started talking about paying tax.
And obviously there's there is the idea of tax. I did say at the beginning we need to talk about tax.
We need
payments.
to talk tax.
So
let's talk about payments now. So this is completely independent and separate from the filing deadlines, although some of the dates are the same, interesting enough. So if you have tax due, then the likelihood is you're going to be asked to pay it no later than the 31st of Jan following the end of the tax year. So back to my example, 2021 tax year finished on the 5th of April this year. You must pay any tax due by the 31st of Jan 2022. However, on that same date, you may be one of the unfortunate ones, if I can call you that, to have been asked to do what's called payments on account. Payments on account are where HMRC require you to pay early towards a future tax bill. So in other words, tax year 21-22. And they'll ask you to make it in two payments. They'll ask you to pay half in January 2022. So by the 31st of Jan 2022. And they'll ask you to pay the remaining half by the 31st of July 2022. So you can find yourself in a really painful place at the end of January, where not only are you paying off the tax that was for this tax year that's just finished, you're paying early towards the tax return for the next tax year that you don't actually yet know what your real tax is going to be. And guess what? RC forecast it for you, aren't they kind? So you're going to have to pay a completely made up number as well in January. Aren't you lucky?
And obviously you've got the second payments account.
Just talked about that one, 31st of July.
However, there are possibilities, is there not, of adjusting your payments account. Why might you be able to adjust your payment account?
It's a great comment you make. So adjust, not get rid of necessarily. So sometimes I can adjust payments on account for our clients, and I'm always looking at this for our clients because I don't want anybody paying over the odds, really, quite frankly, for tax. We pay enough as it is. And we can adjust payments on account if we have a robust forecast for the income for that client for the next tax year, so 21-22. And from that robust forecast, we build a robust tax return draft, and we use that tax instead of the payment on account number, assuming, of course, it's less, instead of the payment on account that's been randomly, for want of a better phrase, generated by HMRC. They do obviously have a process they go through to work out what it is, but we can override that if we have more certainty our number is better and correct than HMRC's. Good news in all of this is that actually, if we forecast a bigger tax bill than that which the payment on account is presenting, we can stick with the payment on account and there's no issue for the client. So we always pick whichever is the lower, the payment on account forecast by HMRC or the one forecast by us.
So that covers off the element of tax deadlines and payments on account.
I'm sorry, I probably sent you all off looking for paracetamol.
I think it's a good way of doing
Sorry.
it. There is another question around payments on account, and it's in particular in relation to, this is a separate question.
Mm-hmm.
How does Section 24 impact employees that previously did not make a payment on account for future tax?
Okay. So let's just talk a little bit about what Section 24 is and what triggers payments on account. So Section 24 affects you if you have property income, which many of our clients do, and your property is owned in your personal name, therefore it presents in your personal tax return, and you have mortgage interest costs associated with running that portfolio. Section 24 has changed the way in which it is allowed to be reported in your tax return. Please don't make the mistake some people do, which is about thinking that mortgage interest is not allowed anymore as a tax reducing cost. It is. We just have to apply it in a slightly different way to that which we did before 2016-17 tax. What it does mean is that it often presents a much larger property profit than there is in reality because of the way the calculation works. And you don't necessarily get all of the lovely tax relief you used to on your mortgage interest costs if you're, for example, a high rate taxpayer, so earning more than £50,270 in this current tax year. So what it can do is it can inflate the amount of income that you're generating. And it can also then inflate the amount of tax you pay compared to maybe 16-17 tax year when it was pre-Section 24. So how does this affect a payment on account? Well, a payment on account is typically triggered under one of two situations. The first is that the amount of tax to pay at the year end, after you've deducted all the stuff you've already had removed via salary, for example, if there's more than £1,000 of tax still to pay at that point, then HMRC automatically trigger a payment on account for you. And back to my point, we work with our clients as an example to see if we can reduce that for them. The second reason that a payment on account is triggered is that even though you might have more than £1,000 of tax to pay, if that is less than 20% of your total tax bill, so in other words, most of your tax bill you actually paid already through, for example, PAYE, salary deductions, then you won't have a payment on account. But because of all these rules and regulations about property income and Section 24, and the fact that your property income might be expanded beyond reality just because of the way it now needs to be calculated for tax, and your tax bill is now bigger, might that result in more than 20% of your tax bill not yet paid? And funny enough, only in the last couple of weeks, I've had multiple clients who earn lots of money from salary, £100,000 plus, suddenly find themselves in payments on account world. They've never seen it before. They didn't understand what it was, understandably, because they've never looked at it and needed to. For no better reason than their property income is now so large because of the way Section 24 makes you calculate your profit and calculate your tax, that now more than 20% of their tax is unpaid at a year end. That's when you get triggered as well.
And not only that, but let's talk about someone who has £50,000 worth of income. And again, relating to Section 24, but they've got children. It could affect, so if you've got children, you can get child benefit allowances and tax credits where you've got earnings of less than £50,000, but they are taken away from you once you get to gross income of £60,000. And if you're a couple, it's the person with the most amount of money that they look at from
It
HMRC.
is.
So your child tax credits can be taken away from you simply because Section 24 adds up the income. So you could be on a salary of £50,000, no profit in your property tax, but because Section 24 and the way that it calculates it, it could go over.
Absolutely. And we're seeing this more and more and more, both in terms of people losing their child benefits or it being significantly reduced, the tax credits, but also things like student loan repayments. They're calculated on the total gross income. And unfortunately, that gross income, if you happen to have a property business and there's a lot of mortgage in it, unfortunately, that's going to inflate the amount of income you earn and therefore inflate your student loan repayments as well. So it's going to speed up the amount you're paying back at the pace you're paying it back. And very recently, I've just seen a client who earns a great deal of money in their job. Without their property income, they would not have had their pension contributions tapered. Because they've got property income, it's taken them above a certain threshold, and now they can't even contribute to their pension as much as they used to.
What about personal? Once you get to £100,000, you also start to lose your personal allowance of 12,570. So if property income, and in particular Section 24, could that also erode your personal allowance? It means that you could be paying up to 62% tax.
It could indeed. So you could find yourself in a place where perhaps without property income, you're close to, say, £100,000 worth of income, but just below. So you get your full personal allowance, happy days. But now when you add on this inflated property profit, and I have clients who have genuinely made, if you look at the real numbers, they've made a loss. Had this today. They'd made a £3,000 loss in their property business because they'd been really good and they kept note of all their expenses. But because of the way Section 24 treats them, they'd actually made a £12,000 profit. And it pushed this person beyond £100,000 and they started to lose their personal allowance as a consequence.
Yeah, so it's quite freaky because this whole thing about owning property, not in a limited company, I used to say, well, do you need to use a limited company? But there's so many more reasons why you would use a limited company.
Never mind risk mitigation.
Never mind risk, but because of the hidden stealth taxes, that isn't so obvious when you're doing Section 24. It's really intriguing to see what's going on. If you're on, if please say hello if you're on YouTube Live. You'll notice I've been playing around with the chat box as Louise was talking.
He can't help himself with technology.
I'm just going to type just say hello all, just to see if this thing works, and it's all come through. So that's perfect. I can see it now. But if you do have any questions, we are live tonight, so feel free to ask your questions, and we'll try and do our very best to answer those. We've got a bunch of questions we're going to get through now.
Oh, okay.
So this is, to be honest, there haven't been that many people who have been asking questions. So
You've all been so busy building your self-assessment tax returns to ask questions.
Maybe. Let's kick off with self-employment and self-assessment. Is self-employment the same as self-assessment?
Oh, lovely question.
Give it a stab and say totally not the same. And we have to remember that self-assessment is all to do with your tax return.
Self-assessment is exactly what it says on the tin. I think it was Ron Seal that used to say that as part of their advert, and it is very Ron Seal. Self-assessment is you assessing by yourself, on yourself, what your tax bill is across all your different income streams, which could include self-employment, so trade activity conducted in your personal name. And I'll come on to what is self-employment and what is not in a moment, actually. So it's about you being very honest with the taxman, putting it all down in writing, using the tax form and telling them what you have earned, what are your genuine, legitimate tax-reducing expenses associated with that earning, and then working out your own tax bill. Although, to be fair, the software, which is very handy. Thank you very much. You bring it to a tax advisor like me, and I do it for you.
I'm not sure what's happened, but as soon as you mentioned the word honesty and doing things with integrity, we've just lost half of our viewers.
Don't be silly. I don't believe you. He's joking.
I
know
am
what
joking.
he's like. He's horrid. So when you are self-assessing what tax you owe, you need to look at all of your income streams, of which one of them could be salary, one could be bank interest and dividends, but also one could be property business and one could be self-employment. And I want you to particularly note, I kept property business separate from self-employment. And that's because perhaps to you and I and your family and your friends and your suppliers and your clients, you're in business. How is that any different, whether it be rental income that you're earning from a property versus consulting advice or mentoring guidance that you might be giving, or training, perhaps? Many of our clients are trainers. There is a difference, and it is a difference only really recognised in tax law and therefore in your tax return and therefore by HMRC. They do not see rental activity generating an income to be what you and I would call self-employment. They see it as an investment activity. I wish it were investment. I wish I could put my feet up and let it happen without any help. But that's just the way it is, and that's just how they see it. And that's why your property income from a rental activity is actually located in a tax return on a completely separate page to your self-employment income. Self-employment activity is activity that is of a trade or vocational nature. So things like giving training advice, providing your skill set to do with, I don't know, maybe being a plumber or being a solicitor. Any of those skills and activities are classified typically as trade, which is a really important definition. And perhaps we'll come on to that another time.
Yeah.
And therefore it sits on what's called your self-employment page, completely separate to your property rental income.
Great kind of overview of that. I think the whole self-employment limited companies we'll do another day.
Definitely.
So let's just go to the other question, which was, is self-employment income support scheme, which is the SEISS, taxable by HMRC?
Ooh.
So let's just talk about the SEISS, or self-employment income support scheme. So people used to get that if they were self-employed, and during COVID-19 coronavirus financial crisis, the government introduced this SEISS scheme during lockdown to help self-employed with their finances, and it was a grant. What most people didn't understand is, well, how is that treated in your self-assessment tax return? And you've been doing some stuff with people who have got this SEISS. How is it treated in the tax return, and what happens with that?
Okay, so there are lots of different COVID-related benefits the government has been handing out to certain groups. And the critical first thing you need to get your head around is, have I been given a loan, which I'm going to have to pay back in full, or have I been given, for want of a better phraseology, free money / grant?
There is nothing in this world as free money. Let me tell you that now.
Not around me, there's not.
No,
That's my husband.
Not. No.
But in terms of calculations, the first step is to really get your head around that point. Is it a loan that I'm going to have to pay back in full? Or is it something that was given to me and I don't have to pay it back? If it's the latter, i.e. it's money I don't have to pay back, then this is likely to fall under something like the SEISS. If you've been given it for activities that you conduct in your personal name, so back to my example of self-employment, then what you're going to find you're going to need to do is, it's not really free, as Simon says. You are going to have to present it in your tax returns, and you present it, for want of a better phraseology, as pure income. It's as though you'd invoiced a client and they paid it to you lock, stock and barrel. So you will have to capture that income, and you'll capture it, as I say, as an income. It's more often than not, it's going to sit on what's called your kind of key core pages in your tax return. So it's like the first 6 pages. But you'll actually tick you've had it most likely in your self-employment section of your tax return. And then you'll load in the value. Here's the kicker. It's treated as income. Income is taxable. So it's now going to add to your taxable gross amount of income, covering off salary, self-employment, property income, all of that stuff. It's going to sit in that pot. And of course, if it's sitting in that pot, it's exposed to tax. So it's now going to get taxed.
I mean, the worrying thing about this, from my perspective, is when you had the SEIS grant, you may have been a basic rate taxpayer. So a basic rate taxpayer paying 20% tax. But let's imagine now that the SEIS could force you to becoming a high rate taxpayer. Mm-hmm. So the government are actually getting more money out of you through the tax of increasing it from 20% to 40% that you completely wasn't expecting.
And that is a possibility. Many of the grants are means tested in the sense that they look at what you were earning previously. So they are there to a degree to replicate and replace the lost income. So you may find yourself in no worse a position than had you earned the income, had COVID not occurred and the world had continued and you'd continued to earn income. But to Simon's point, you're absolutely right. There could be situations where typically you'd expect to lose £2 in every 10. Now you're losing £4 in every 10. And all of a sudden that £10,000 grant you've just had, you're actually paying £4,000 of it back immediately almost to HMRC as tax. That doesn't feel very loving or grant-like to me, but that's just the way it is and that's how it's calculated.
And just to make it absolutely clear to the audience, I'm always right. Okay, moving on. So let's go to the questions. And what I've been able to do on our overlay, I've been able to put our question whilst we're answering it on the overlay. So it really helps people to understand.
He's tinkering, isn't he? He's tinkering with the IT again.
The new technology is out there to be used. So the question, actually, funny enough, is something that Donald's asked a question. And it was funny enough, it was on our Google Next listed question. How interesting.
OMG.
And how bizarre is that? So the question I'm just going to put in here. Hopefully everyone can see it. There we go. Donald has asked a question on YouTube. I love this feature. I've got to be honest. This is my new toy. I'm doing YouTube Live every night. So Donald, as you can see there, Donald's asked a question. As an expat, capital gains tax declaration for sale UK property, which has been let out for 14 years. So let's put this into context. So you had a buy-to-let property
here in the UK,
and then you leave the UK, and then you think about selling the property. Really interesting aspects, something called NRCGT, which stands for
non-resident capital gains tax.
Right. And the reason why it's interesting is because there are 3 valuations. And I'm going to go with the 2 because it's just easy with the 2.
Okay.
But there are 2 methodologies that I kind of use quite a lot when we're doing non-resident capital gains tax, because typically capital gains tax is based on the sales price less the purchase price will give you the gain. You get this annual exemption allowance, and then you have a net gain which you're taxed on. And give you a quick example, you could have a sales price of £100,000, you bought it for £50,000, you had a gain of £50,000, and then you get your £12,300 allowance deducted as well. But just keeping with the £100,000 and £50,000 to give you the £50,000 gain, there's a lot of numbers here, so I'll restate that all. £100,000 worth of sales.
I'm surprised you've not typed it in already.
I daren't. £100,000 worth of sales. £50,000 is the original purchase price, and then £50,000 gain. What's really interesting about this is that you can take the April 2015 date for residential property. It's slightly different for commercial property. Do you know what the date is for the commercial property?
Yes, it's 1 year later.
Yeah, 16, isn't it?
6th of April 2016.
So let's imagine that you bought it for £50,000 way back when. And in Donald's case, I think it's about 14 years ago. But let's imagine now that the valuation as of 2015 was £75,000. All of a sudden, things change because you have the sales price at £100,000. That doesn't change, of course. But the purchase price, the deemed cost of that property, will no longer be the £50,000 that you originally bought it at, but it'll be at the revaluation of April 2015 of £75,000. So your gain is now just £25,000. You're smiling. Have I done something wrong here?
No. I was just about to say there'll be probably a lot of people out there going, oh, does that mean I can revalue my property and I don't have to pay the capital gains tax I thought I was going to? I'm sorry to be the bearer of bad news and a real humbug.
Is that kind of a roll there on a horse there?
Yeah, whoa there.
Right.
But this only works non-resident at the time you sell the asset and remains so for a minimum of 5 years. Okay. So sorry, this is not a get out of jail free card, so to speak, for everybody when it comes to tax treatment of capital gains. It only works if you're not resident at the time you sell. And like I say, you're not resident for a minimum of 5 UK tax years.
Yeah, there is a double whammy here because obviously we're saying how someone can reduce their tax liability, but Interesting enough, we had a client that was moved to a different country, and the way that they calculate capital gains tax was income tax. So pretty much what Rishi Sunak was trying to explore, and he mentioned nothing in the last budget.
Did you not know Rishi Sunak was wanting to simplify capital gains tax?
Well,
in other words, move it to income tax? Did you not know that?
He basically no, I'm not having that. So I'm a Rishi fan, not having that at all.
Hashtag Louise for president.
Yeah, president.
Absolutely.
One country.
I'm taking over the lot.
So that's why you got the Democratic jargon today.
How dare you?
Right. So from that side of things, the idea behind it is that if you are moving countries and you're selling property, albeit the NRCGT or non-resident capital gains tax could be beneficial from a UK perspective, it could scupper you in the country that you're living in, because places like US, Australia, many other countries, even Spain, will tax you on your worldwide income and your worldwide gains. So if you're selling property, not only you got to think about the UK tax, you've got to also think about the tax and the country you're in. So Donald, I don't know what country you're in, but do research, because it may be a position of going, well, yeah, that's great. I've come onto this show and I've saved some UK tax. But actually, Donald, you do need to look at where you are now, and is there any tax implications of selling that UK asset?
Yeah.
Anything
if
to
you're
add
in
on
Hong
that?
Kong and Kuwait, amazing. I do have a couple of things, if I may.
Please do.
These rules, and you're probably saying to yourself now, Donald, oh, darn it, I didn't get a valuation on the 6th of April 2015. Why on earth didn't I do that to know what the value of the asset is? The great news is that if you work with RICS surveyors, they can do a calculation to work backwards to establish what the value of the asset was at that time. But you can also do what's called a oh gosh, my brain's gone dead. What's it called? Where you just do the average across. I think it's called an averaging election.
It is averaging election.
Whereby you look at the full period of time you've owned the asset, and you look at the time, the number of days, if you like, in total. And then you look at what proportion of that total time has been since the 5th of April or 6th of April 2015. And you then look at your total profit you've made at sale or loss, and then you only apply the capital gains tax calculation to the percentage of time that has transpired since the 6th of April 2015. So don't feel like, oh my goodness, had I known this, I would have got a valuation. I'm in a real mess now. I can't do that. Like I say, two options. Go to a RICS surveyor and ask them to kind of calculate backwards, and also do that net kind of calculation across the total. And here's the lovely thing. HMRC will let you apply whichever of those calculations gives you the best result for you.
Just some as an aside, Phil Ashford, by the way, on LinkedIn. Good afternoon. This is good evening.
Hello,
Phil. Long time no speak. Hopefully you're well, sir. Thank you for joining the show. We'll feel honoured now to Phil on the show. But anyone that's selling homes, you'll know about private residency relief. So if you sell a home, there's no capital gains tax for the period that you lived in the property, and you get this extension. However, we've been doing a show for Americans, and you'll start to see these videos coming out from us as well. But if you are vacating or living in America and you sell your UK home after you've moved to America, you may end up paying capital gains tax on your own home, because they only give you £500,000 if you're married. Or if you're single, $250,000, by the way, so you're not even pounds, as a relief. So you could sell your own home, think you've got no tax, IRS knock on your door and go, thank you very much, sunshine.
It's all about
I don't
timing.
think Americans say sunshine.
Probably not.
No.
I don't think many Brits do either, but there we are.
I think they do.
All I would say is, as always with life, it's about the timing. Timing it so that you're classified as non-UK resident if you want to try and get this particular non-resident capital gains tax benefit. And timing it so that the country you do become resident in, you're not actually tax resident in it at the time that you sell the asset, which I appreciate is a bit of a juggling act. But oh boy, could it save you a lot of money if you get the juggling done right.
Talking about non-residents, Phil Ashford is also cowboy hat, coming to the rescue. Or knight in shining armour?
Sorry,
I don't know.
Phil.
Cowboy or knight in shining armour?
So sorry,
Cowboy's
Phil.
got the wrong connotation. But he is right. He's put on LinkedIn here, say, not forgetting that your agent or tenant should be deducting 20% of rental profits at source and sending it to HMRC. Or which is at least helps set aside money for your tax bill. If you want it gross, fill in the NRL1 form. So there you are, guys, as a good letting agent from Comfort Lettings in Nottingham that specialises in HMOs for the student market. Contact Phil Ashford on LinkedIn.
What a
there
plug.
You go. I think
What
that's
a plug.
an amazing plug. To be
I
fair,
think you should be wearing the Stetson now.
Sponsorship money, very much welcome. For that plug. But no,
Sorry, Phil.
Phil's, what do you mean? Sorry, I've just given him a massive plug. He's just had 3 minutes of airtime. So Phil is right. If you are foreign, you'll be getting your income. You may end up having 20% tax deducted at source, but you can ask for it for gross, especially when you think, well, actually, I've got my personal allowance still, even though you're in, let's say, Europe. In the UK, you've got personal allowance still. Therefore, you might not have to pay tax on it. So why pay tax up front? Get it paid gross, do your tax return, and then you may not have to pay tax. But again, you do need to do an awful lot of tax, international tax. Not that I'm plugging this, but I am focusing very much about Hong Kong, Spain, and America tax combined with the UK. So anyone listening out for that, guys, then feel free to drop in a question. Okay.
Thank you, Donald, for your question. Hopefully we've answered it. Do let us know.
Yes. Here's a question. I'm just going to put this up. Look at this. This technology is so awesome. I'm just so happy. I've never seen this before, and it's just come onto my screen. I need my glasses for this, though, and it's ridiculous. It says, if I lived in the property up to 8 years ago and then let it out, will I have to pay capital gains tax on the whole selling value?
Oh, that's a lovely question.
I'm going to let you have that.
That's a lovely question. Sadly, some of the capital gains tax reliefs have changed in the last couple of years. But the good news is you still get what's called a private residence relief, principal private residence relief. Lots of people call it slightly different things, but it's often referred to as PPR. And what that does is it looks at your total ownership of the asset, and it then basically discounts the amount of gain connected to the percentage of time you lived in it plus the final 9 months. So what did I mean by that late on Monday night? So let's say in simplicity that you owned it for 10 years. The first 2 years you lived in it, the final 8 years you rented it, then you sold it. Whatever gain you've made, arguably, you're going to be able to ignore, in effect, the first 2 years of that. So in other words, 20%, because that's when you lived in it, and 20% is the equivalent of the period of time you lived in it. And on top of that, the final 9 months as well. So in other words, an extra 7.5% based on the calculation. So that means that you can ignore 27.5% of your gain before you even start applying things like your annual exempt allowance and then working out your capital gain on top of it. Historically, there was something called lettings relief. And sadly, unless you're living in the property with a tenant at the same time as you're renting it, you're not going to get that anymore. But you will get, as I say, the principal private residence relief. There are certain conditions under which you can actually extend that final 9 months of as though you lived in it, called deemed residence. So if you meet some of those criteria, it's worth looking into it in more detail. So for example, if you were disabled under a certain set of classifications and conditions, or you were moving into care as a consequence of moving out of the property. So there's some areas where you can slightly extend what that principal private residence relief gives you. But the good news is if you have lived in it as your home, you are going to get some relief.
I was just looking at another aspect of the private residence relief, and it's about whether you move back into the property.
It is. So if you have moved back into the property, potentially you can have another 3 years in between when you left and when you move back in, as though it was your home again. So there's lots of opportunities here to kind of get the very best out of this principal private residence relief. And only this year I was helping a client. They've sold a property. They've made a gain of over £1 million. And I was able to bring their capital gains tax down to a whopping £3,000. So they were very happy, understandably. And that was all about applying principal private residence relief, deemed relief, and really working through the options of how to calculate out the capital gains tax, following the rules, of course, but also following the rules on all the different reliefs.
Yeah, it's a really good point to make on that kind of thing. Phil's confirmed cowboy. So there you are. Yeah, I would have gone with that. You get chafing, don't you, with cowboys?
Move on.
But with nights, it's even worse. So I'm going to come back to Phil's question in a second because there's quite a lot of questions coming through, which is great.
Amazing.
Dom TH27.
Hello, Dom TH27.
Let's see if this works on this. Yes, it does. This is awesome.
Oh, you're liking this, aren't you?
I'm loving this. So it comes onto your screen. It's brilliant, right?
He's so happy with tech.
Well, it's not just
I know
tech.
what Santa's bringing.
This is a marketing 101, how to do it right. Okay, so can I change from remittance basis to a rising basis? I have foreign income and I'm a high rate taxpayer in the UK. And let's talk about this because the remittance basis, people go, but if you are living in the UK, there are different ways that you can treat your foreign income. There's the
if you're not domiciled.
If you're not domiciled, and we'll talk about that in a second. But if you're moving recently in the UK, and I'm going to give you a magic number here, Louise, which I would say 7 out of the last 9 years.
Oh,
we'll come back to that.
He's cheating now. He's reading notes.
There's notes. So if you have been in the UK for less than 7 years, I would say that it's totally possible for you to be taxed on just your UK income by HMRC. And you could say, well, actually, I don't want you to tax me on my worldwide income simply because I'm going to keep my money in that country. Okay, so let's imagine you've got £100,000 in the UK. You'd be taxed in the UK on that by HMRC, but you've got $100,000, let's say, in America. And you can say, well, I'm going to use the remittance basis, so I'm going to bring in $50,000. So you can tax me on that $50,000, but you can't tax me on the other $50,000 because I'm leaving it in America. So that's the remittance basis.
It is.
Comfortable with that?
I am. The only downside with remittance, I would say to you, is that after a period of time, which I know Simon's going to come on to, there's a nasty kicker from HMRC because they don't like you doing that. They want to tax you on everything. Yeah. Secondly, the moment you're under remittance basis, kiss goodbye to personal allowance, kiss goodbye to annual exempt allowance. You don't get those.
But I would argue that if you've got in that example whereby you've got $50,000 and you want to bring that into the UK, personal allowance wouldn't really come into it.
If you're already earning over £125,000 or what you remit into the UK plus what you earn here is over $125,000, it's not going to affect you on personal allowance. Yeah. It really doesn't matter.
However, I did say at the beginning for 7 years, okay, here's a kicker, because HMRC don't like the remittance basis at all. So what they will do is if you've been in the country for 7 out of the last 9 tax years, they will apply £30,000 as a charge. So irrespective of how much tax they're going to charge you on your income streams, they're going to slap this extra £30,000 as well.
Why not?
It's small, right? I mean, it's small. Just get it out of your back pocket, pay the HMRC the £30,000 and be done with it. Excuse me. So, and it gets worse because if it's been 12 out of 14 years, then that will go from £30,000 as a basis charge to £60,000. Finally, if you've been in the UK for 15 years, and I'm going to come on to it for 2 different aspects. So strap in, guys. Strap in proper. Because I always talk to clients when we're coming over to the UK, and they say, well, I'm going to live in the UK. I think you're crazy because the weather's rubbish. And I'm talking to people from places like Hong Kong where it's nice. All right, it's humid, but, come on, guys. Why in the UK? It's raining. Just look out the window.
They're never going to hire you to bring in people for holidays.
I know. A place in the sun. Not in the UK. Anyway, that aside, 15 years. Why 15 years important? Well, you become domiciled. So that means that your worldwide income will be subject to UK tax by HMRC.
Even if you don't bring it into the UK?
Even if you don't bring it into the UK.
You're now forced into being classified as domiciled here in the UK, which means every single penny you earn, no matter where you earn it, must present on that tax return here in the UK.
But what's worse than income tax, though, Louise?
Oh, I don't know. Simon with technology is very excited about.
Well, that is a good thing. That's a very positive thing, by the way. So I pipe down. Inheritance tax. Because let's imagine that. Oh, sorry, if I tread on your foot.
Don't worry. I'm used to kicking
I meant to stab on it really hard. Given your last comments. But the idea behind it is if you are coming to the UK and you've got the assets, your inheritance tax liability would only typically be for the assets held in the UK up to 14 years. And that's a real crucial number, because I always say to clients, isn't it time that you kind of off? And they think, hold on, mate, I don't.
Simon doesn't mean about killing.
Yeah, well, definitely not that. But equally, I don't mean get rid of them as clients. But I do say to them,
moving out of the UK
it's time to move on, as in go to a different country, because on the 15th year, your worldwide assets would be subject to inheritance tax if you're not careful. I mean, there is the excluded property trust, which can shield you partly away from that, to be honest. But you're still, at risk of all of your assets being subject to inheritance tax, not just income tax, on the 15th year.
And there are some exemptions to inheritance tax. There are some exemptions, so business property and farming property in certain instances. But do you really want your whole world exposed to tax on your passing? Probably not.
Do you want the whole world exposed?
Well, all of your worldwide income and assets.
So many jokes. Right, okay. Let's go to Phil Ashford. So Phil is asking the question, are there structures that an overseas investor in the UK should be considering? I'm going to use America again.
Go for it. Him and his Stetson, Phil. Sorry.
So if you're an American coming to the UK, typically a lot of people would say, if you're from overseas, set up a UK limited company because it's nice and easy. And I'll give you an example here, interestingly enough, is Hong Kong. If you're a Hong Konger, typically your tax rate will be around, I would say, no more than 16%. The top tax rate, funny enough, 16.5%, that kind of ilk. And we know that corporation tax rate in the UK is 19% currently and will be going up. So I don't want to call it tax dodge, but one of the things that you can think about is if you are in Hong Kong, you could pay yourself a wage from the UK into you as a Hong Konger, and because it's paid from the UK to Hong Kong, you don't get any tax, or you might have to think about a foreign office, so you may have to then start paying 16%, but it's less than 19%. And therefore it could be more beneficial. So in foreign countries, you do need to think about, well, I've got the UK corporation tax at 19%, but what is my income tax rate on wages if I took the money out? Because you might save 19%, but how much tax might it be in your own country? Is it less? If it is, pays off wages, rather than people that set up limited companies and then paid themselves dividends out of it. Because the £2,000, and here's the kicker, the £2,000 worth of tax-free dividends from a UK perspective absolutely doesn't apply anywhere else. So some of the tax initiatives and incentives that you have in the UK, if you're foreign, you can kiss goodbye to that, because whereby you save it in the UK, you get hit in your country that you're in. So it's a great question, Phil, but it's never an easy one to answer, because it really does depend on the country that you're in. And I mentioned about the US. So Hong Kong, very, very tax efficient, going to do lots of nice things. But in America, they bought this new tax in 2018 for the TCJA Act. Oh, total job cuts act, by the way. Just, but they brought in this new ruling called GILTI, which is the looking at your companies that are in low tax countries typically. And it was aimed at Apple, funny enough, years ago when they had offices in Ireland. And the IRS just don't like anyone. So anyone avoiding tax, they're straight on it. And they're dominating the world, because now every other country has to comply with, if you have a UK limited company, the IRS will tax you personally on the profits that company makes. That's right. So you've got a company that makes, let's say, £100,000, and you, as an American, you might say, well, I'm not going to distribute any of that. I'm going to leave it in the UK, and therefore I'm not going to be taxed in America on my own for tax. Not the case. No.
No escape.
GILTI means I'm going to look at your limited company, look at the tax profits it makes, and I'm going to give it a massive tax bill straight on there, as though you have distributed all of the money. And if you then do distribute the money in the form of dividends, they tax you again. So you could pay 50% tax on assets that you've got in the UK because of this GILTI. Now, there is a lot of reforms going on. There are changes, I understand, that's coming in next year. And there are ways around it. But Phil, it's a great question about, I could talk all night about international tax.
As you can tell.
Passionate about it,
I thought this was self-assessment.
Oh, yeah, I forgot about that.
Oh, yeah. Right.
So that's Phil's fault, cowboy.
Don't blame Phil.
Right. Okay, so let's move on. Phil, that's Phil Meek.
Peter.
Oh, sorry.
Hello, Peter.
Oh, he's a client of ours, right? Is that our Peter Meek? Maybe not. I'm not sure. Can you pay money to a SASS if you are not UK resident and have a UK company? We are in Australia. Poor old Australians. Your tax liability is 50% of your income. I feel sorry for you down under.
Not nice.
It's lovely weather though, so it's worth paying it. In my view. What's your thoughts? I mean, it's a UK company. SASS pensions typically requires you to be an employee of the company before it can make contributions for you. So you do have things like net relevant earnings in which you can have your pension contributions in. So if you're Australian and not UK.
I would say this is a wealth advisor conversation because I'm not aware there is a way you can do it, but I'm not saying there isn't a way. And I think more often than not, it's the wealth advisors who can establish for you methodologies that allow you to fall absolutely between the two black lines of what's allowed, but do so in such a way that it gets you the result you want. So go speak to your wealth advisor. If you're building up a SASS or thinking about commencing a SASS, go talk to your advisors about how that would work for you.
Well, interesting enough, we've now teamed up with Natalia Woods, who do an awful lot of SASS stuff. So Greg and James from Natalia Woods are doing some excellent work with our clients. So if you want to try and reach out to us at Optimize, info@optimizeaccountants.co.uk. Peter, send me that question and I can get that answer to you. I rather suspect that if you're Australian, I think it's very tricky to get a sign-off from HMRC on that point.
There are certain rules that allow certain countries more lax approach, and I don't mean that in sense of getting around tax, but Australia might be one of those because of the way I've seen the double taxation treaty written, but I'd want a wealth advisor to really guide you better on that.
Some good questions. And it's quarter to nearly 10 to 8.
What?
I know, shocking.
10 to 9.
10 to 9. I'm an hour behind. Where is 1 hour behind? I don't know. Okay. Next question, again from Google. This is, so when do I need to file a CGT report? Oh, I'm glad this come out. When I've sold a residential property, just to be safe, impact on SA. Now, capital gains tax reporting. So let's think about this. If you sell a property, residential, and you make a gain or not, I would say file a tax return to HMRC.
What kind of tax return?
Well, a capital gains tax reporting, thank you very much, rather than your normal self-assessment tax return. And the reason for that is it does say quite clearly on HMRC that you don't have to do a capital gains tax report within X number of days. You'll know why I'm saying X number of days in a second. But I would say that you should just do the report. 2 reasons. One, even if you're not making a profit and you make a loss, you want to put it on tax return anyway. Okay, so do that. If you make no gain, there are still possibilities of having to do a tax
particularly if you're non-resident. Yeah. So if you're non-resident, no matter whether you've made a gain or a loss, whether you have tax to pay or no tax to pay, you're forced into reporting within the period of time that Simon's going to talk about. If you are resident here in the UK, as in tax resident, then arguably you only have to file the tax return under certain conditions. If you're likely to sell a couple of assets, and this is where I think it really comes to the fore. So let's imagine you're going to sell a couple of residences in a particular tax year, one of which you're going to make a loss on and one of which you're going to gain on. Let's imagine you sell the one that made a loss. Arguably, you don't need to report that, so that's fine. If you didn't report it, when you sell the one that you made a gain on, guess what? When you come to prepare your capital gains tax form, you can't even record the loss to help mitigate the gain. So you have to pay the capital gains tax in full as though you'd made no loss, because typically what you can do is set capital losses against capital gains before you work out your capital gains tax bill every year. But if you haven't recorded that capital loss residential sale on these new capital gains tax forms, then you won't even be able to record it as part of the calculation for the second property where you've made a profit. How mad is that? It's just wrong.
So I think that's really an important thing, isn't it, in terms of the reporting. And now the reporting has changed as well, though, isn't it? So it used to be 30 days
post-completion,
but now it's 60 days.
Hooray.
So they are giving you more time to report your capital gains tax liabilities, if any, and pay that capital gains tax. Now the big question is, well, when I did the reporting, I was a basic rate taxpayer, but then on my self-assessment tax return, I got some dividends, I got some interest, it made me a high rate taxpayer. There's obviously going to be a differential from the tax you actually paid versus what your self-assessment tax return will say you should have paid. And for my money, all that will happen is the fact that they will just say you've got to pay more tax. But my understanding is this: if you've got a shortfall, they could charge you interest on that, couldn't they?
Correct, they will. So here's the thing, just to bring that to life for you. If you sell a residential property and make a capital gain or a capital loss, you need to report that within 60 days by completing the capital gains tax form, which is all online. So you've got to know your online criteria and ID details for HMRC. So make sure way before you're at the sale point, you've got everything set up. Secondly, you're going to have to pay a estimated capital gains tax bill at that same time, so within 60 days of completion. And then, to add insult to injury, you've got to load all that same information into your self-assessment tax return when it comes around to filing for that particular tax year as well. And if, as Simon says, when you actually add up all of the incomes you've had and you work out you actually under-egged the capital gains tax you needed to pay because you didn't realise you had certain types of gain, it wasn't obvious to you at the time you were filing your capital gains tax report, and actually you've underpaid your capital gains tax, well, I'm afraid you're going to pick up some late payment interest as well.
I mean, I think the one question I've just got here, and again, this is Google research more than anything else, is people that are not sure if they need to do a tax return. So let's talk about this, because if you have got typically property income, you would need to do a tax return. However, and there are some bits and swings and roundabouts here, isn't there? About £10,000 worth of income and whatever else
to work it out.
But you don't have to file a tax return just because you make some money from property. And when I say some, I'm certainly talking about less than £1,000 worth of profit, that you don't have to declare that. So if you made £950, for instance, then you wouldn't have to declare that. Similar to self-employment, if you make £1,000, and there's Mark Kohler, funny enough, he is an American CPA. He often talks about having a side gig, and I like that phrase, side gig, or side hustle.
I'm going to have to buy him a Stetson, aren't I, Phil?
In fact, you know what? I'm going to have to get it now. Yeah, here we are. So
I'm so sorry, everyone.
Oh gosh, I'm going to see my. Here we go. So this is Mark Kohler's book from American Tax.
Oh, I thought he was going to get a Stetson out. Thank goodness for that.
No, your heart. So the reason why I bring that up is because, in fact, I have forgot where I was coming from. That is a shocker.
That's awesome. I love that. We're talking about side gigs and profits,
self-employment,
and how
right?
much you can.
I know that. I was just testing you out. So if you had self-employment of £1,000, you wouldn't need to do a tax return. It's only in the excess of. Equally, if you have got employment income up to £100,000, then you don't need to do a tax return. However, I kind of think you should. And why is this? Louise, out of 10 clients that we have employment income, how accurate are the employers when they're doing PAYE? Out of 10, how many is perfectly correct?
5.
I've put it on the spot here. 5.
It particularly proves itself to be worthwhile doing a tax return where you have a substantial portion of your income every year generated via bonus. So, for example, performance-related bonus, where your employer won't know necessarily until they do the calculations just before they pay you that bonus, how much bonus you've actually earned. And the reason for that is that employers this time of year typically are asked to forecast what they're going to pay you as a employee from April next year through to the following April. So, when you take into account, it could be 18 months in advance. And most employers will have a good understanding of what that's likely to be, but they won't necessarily know about future performance bonus. They won't know about, for example, if you're changing role in the business, if you're going for a promotion and get it. So their calculation is flawed. They share that with HMRC. HMRC build a flawed PAYE report to say what they should be taxing you on. They send that flawed report back to your employer, who then apply that flawed report into your PAYE calculation. And as you can see, it becomes a vicious circle. I find quite frequently, more often than not, that employers have overtaxed their employee because they get penalties from HMRC if they undertax. So they're more likely to overtax you if they're not absolutely certain, because nobody wants to pay a HMRC fine, but it's all right to charge you extra tax because, you'll work it out eventually. So I often find in tax returns for clients where there is a substantial performance bonus or there is an element of change that's happened in their working environment and their salary, that their tax position is completely wrong just on their salary portion alone.
I've just noticed I've been running Zoom at the same time, which if I press the meeting end, will it end the meeting here? No, it hasn't.
No.
I was thinking, that big red button, don't press it. And everyone looks at the big red button, don't they, for a long time.
There's a great book, a great kids book called Don't Press the Button.
And everyone does.
And what does everybody do?
Of course they do. It's there to be pushed.
Don't press it.
So there's a great question. And I think Phil knows the answer to this. Okay.
Phil, you're not asking another question with the steps.
But he's given me the opportunity to flash on the screen. I wonder if this comes through on YouTube Live. I'm going to have a look. But Phil's asked the question: can PAYE taxpayers who have investment property deduct any costs for working from home? And we do deduct. I'll let you talk about that.
We do deductions.
We do deductions. Ken Dodd-Dedman didn't die. Ken Dodd did. Right.
Oh dear.
Or any other sunk costs that didn't come out of the bank. Travelling to the property inspection. I know Phil knows the answer to that. So bless him. He's just trying to give us nice material for this show.
You are kind.
He is very kind. So let's talk about. For anyone, it's an in-joke because Phil Ashford from Comfort Lettings in Nottingham, specialising in HMOs for student-let accommodation, is a qualified accountant. Okay, so he knows all this stuff. So he's nice. But let's talk about
qualified
this.
Stetson wearing accountant.
Yeah. So let's talk about taxpayers working from home. There has been a working from home deduction, has there not, because of COVID? People have been asked to stay at home. HMRC have been very generous, haven't they?
Hugely generous.
Tell us the rate.
So if you Google use of home, HMRC, you'll bring up a really interesting insight that says if you're working more than, I think it's 100 hours a month, you will basically be able to claim the equivalent of £312 a year as what's called a flat rate expense. And that's basically an expense that requires no receipts, no information to validate or prove that you spent that. And that's to reimburse you for things like utility costs that you might have incurred at home. Interestingly, over and above that, if you've used a mobile phone for your business, if you've used your home broadband and home telephone for your business, then you can claim a proportion of that as well, depending upon how much of it you've used for your business compared to kind of home life. So that's a really nice have if you haven't already calculated it. Some people actually calculate what they call use of home through an apportionment method, which basically is quite painful. And almost every time a client is quite adamant they want to follow that process, when they follow the rules that I explained to them, they end up getting less than the 312 plus some of their mobile phone plus some of their home broadband. And actually they kind of go, oh, you know what, Louise, sorry, you were right. Let's move on. So that's what we end up doing. You can also claim that 312 as a use of home against your salary if you were required by your employer during the COVID lockdown to work from home. And it doesn't matter whether it was for 1 day, 1 hour, well, probably more than 1 hour, but definitely 1 day, versus the whole year, you can still claim that use of home of £312. So, you could get double benefit from that 312, quite frankly, and it's worth looking at. The only thing I would say is some employers have been really savvy about this, and they've already given you that deduction through their PAYE calculation. So just make sure you're not double counting it and your employer hasn't already gone and got it for you.
Phil has raised an interesting question about mileage, and it's something that most of our clients do forget, and me included. But if you think about travel allowances, typically you can't have a travel allowance for moving from your home to your usual place of work. But if you're a property investor, you might be looking at, as Phil pointed out, that you might be going to see properties, you might be going to see, funny enough, comfort lettings in Nottingham, specialising in HMOs.
Buying your Stetson for your business.
You might be doing that.
Hard hat Stetson.
On Mansfield Road, no less. So equally, you might be going to all sorts of places for property related, and you can get a deduction for it. And the best way to look at this is that you can get allowance. I'm just going to put this in because I've just noticed on there, look, you see the URL coming up here, Louise. I'm going to put another URL.
Oh my.
Watch this.
He's going mad. He's loving this new tech.
It's just taking it up. This is just taking us to a next level. It feels like I've been zapped into the new generation.
I'm so sorry, everyone.
Star Trek, next gen, Gen X. So that URL, please do look at it because it's really useful. It tells you about the allowances you can claim, and it's 45p per mile. And interesting enough, on this website, on the HMRC, they talk about 45 pence for the first 10,000 miles, and then it goes down to 25 pence. But did you know that if you was taking Phil from Comfort Lettings in Nottingham, Mansfield Road, to see a property with you, if you're buying properties, HMOs, typically for students, which Phil might manage for you. I might have done it now. But you could claim for Phil as well.
5 pence extra per mile.
But not only that, but you could take someone else, a joint venture partner, and it's 5 pence per passenger.
Don't
so it's 55
go out
pence per
and buy
mile.
a bus just to take everyone with you.
One client talked about that, didn't they? But ultimately, you could claim 5 pence per mile, and HMRC are pretty silent on that kind of thing. What I do like about it is if you're a fitness freak and you want to ride on your bike, why not get on your bike, see a property that you got a viewing for, and you can claim 20 pence per mile just by riding your bike. I mean, get fit, get a tax relief.
I'm so sorry, everyone.
Get fit tax. I mean, it just sings. Just sings.
Moving on.
We have to, because it's 9 o'clock.
Wow.
So I've enjoyed tonight more than I thought.
I'm so sorry, everyone.
So thank you ever so much for joining us. I think this has been really, really useful to talk about self-assessment tax.
Did you know it's self-assessment tax filing season, everyone?
Yeah.
Did you know?
And if you're in Hong Kong, you're late. By the way, so
OMG.
that should have been done in June. By the way, if you're an American as well, you're late there as well. Just by a few weeks. So thank you ever so much for joining us. We will be doing these sessions. We are going to do one less session per month. So we will be doing one live session combining UK tax with UK tax returns. So we used to do 2, but people getting confused which one's which. So we will be doing this show in 4 weeks' time. So come and join us for then. It will be December. By that time, you would have all done your tax returns, wouldn't you?
Absolutely, you will have done.
Phil, you done your tax return, buddy? So thank you ever so much for joining the show. We look forward to seeing you all again very soon. Good evening.
Thank you very much.